Would you agree with the idea that U.S. exceptionalism has been financed by fiscal recklessness? Possibly, is that the reason why rates are so high? Therefore, the dollar's strong. Rates, all the QE that we did to support our fiscal recklessness actually allowed consumers and corporates to get their balance sheets correct. And all that was kind of borrowing from the future. That's why we're so strong now. But when we actually have to deal, because I think the U.S. is the fourth most indebted country in the world, behind Japan, Italy, Greece. Thank you. So when we actually have to deal with that issue, does that mean U.S. exceptionalism goes away? And therefore, possibly the strength of the dollar, possibly the strength of the stock market. Just kind of unpack what happens to asset classes, if you would, given the world that we're going to face.
Recently, I stumbled upon a conversation featuring Paul Tudor Jones and Stanley Druckenmiller, both considered among the brightest minds in the financial world. They delve into the current state of the United States, addressing economic and geopolitical challenges. They talk about the impact of artificially inflated markets and the massive amount of US debt, and try to predict the short and midterm future of our economy. Keep watching, because in the video, Druckenmiller also shares his ideas on what assets investors should look into in an economy like this and what he is investing in.
Well, our exceptionalism extends way beyond the area we're talking about. We're still leading. We've let every technology move in the last 35 years, and now we're leading AI. Our military is still strong. While we're all griping about where we live, talk to one immigrant who doesn't laugh at you and say, man, if you think it's bad here, this is the greatest place in the world to live. But because of our reserve currency status, we've gotten away with a lot. Yes, corporations have termed out, but only till 25 or 26. Mortgages are a little different. It'll take 5 years to get the average mortgage up to 5%. New mortgages are over 8%, but the average mortgage is 3.6%. But we also had all this legacy liquidity after the Fed and Congress did their thing in COVID. That's running down rapidly. We have QT running down rapidly. Oil interest rates are up. It all targets toward, this has been an ephemeral period when at least the equity market and the economy has ignored stuff. But looking out, particularly in 25, but maybe in 24, you have to be open-minded to something breaking. And don't forget, I quoted you averages. Economics works on the margin. So, yeah, there's companies that have termed out. There's also a bunch of small businesses out there are really hurting. And we're starting to hear anecdotal evidence for the first time. It started about 5 weeks ago, that on the margin, things are getting softer.
The United States is currently the world's leading power, and as such, it's often the subject of doomsday predictions in the finance world. While acknowledging some truth in these warnings, it's essential to recognize the US's dominance in driving technology and maintaining the strongest military globally. But we have to keep in mind that the recent methods employed by the US to bolster its economy would cripple most nations lacking the benefit of having the reserve currency. If we take a look at the stock market, we can see that it has been pretty much stagnant since the beginning of 2022, even though we're in a quite hard period in terms of inflation and interest rates. If we take a look at this year's performance, the S&P 500 is up around 11%, which is not bad at all. But a more interesting indicator is the S&P 500's PE ratio, which in the last 5 years is up from 19 to almost 25 times earnings. Druckenmiller thinks that we lived in a world of quantitative easing for a long time, and now it's time for the market to normalize. He also talks about mortgages. It's evident that real estate has witnessed a significant slowdown due to escalating interest rates. We don't even have to talk about commercial real estate, which is in the most trouble. But in the big picture, if mortgage rates are rising, then people will have to allocate more of their monthly income to pay their mortgage. Because of that, people will have less money to spend elsewhere. Combine that with the current geopolitical challenges, and it's not hard to agree that we have to be open-minded that something will break. But let's hear what he buys in times like this and what he thinks people should invest in.
So let's just go through this. Stocks, again, with the world that we're facing, what's your investment strategy for the stock market, stocks in particular?
The stimulus the Biden administration has done is obviously very targeted. Most of it toward the green economy, the IRA, and it's bigger than they said, but you've got subsidies and tax breaks on top of it. That will create opportunities in the stock market. There's a big thing going on in AI that'll probably create opportunities in the stock market. But that very stimulus puts pressure on rates, which will cause all kinds of other things within the stock market to break. Look, we've been through 2 or 3 months of a pretty devastating period. All I know is every sale I made, I'm happy about, and every buy I made, I'm not thrilled with. The sentiment positioning is such that I'm not really excited about being short in their intermediate term. Maybe more importantly, longer term, we have this belief in this country that stocks always go up over the longer term. I said a couple years ago, and I still believe it, I think the S&P was 4,500, about where it is now, that I thought the equity market would be the same place in 10 years that it is today, that it was then. Why did I say that? Because again, we had a bubble, we had a QE period for 10 years, and we need to make an adjustment fundamentally and price-wise. And if you look at the market in the non-QE world, pre-world, 15 times earnings was about right. We're at 20 times earnings. I don't know what we're doing at 20 times earnings.
And that's earnings that are supposed to go up next year.
No, that's sort of our estimate of where they are, where they're going to be this year. But I don't think they're going to go up next year. I think flat at best. So it's hard for me to get excited about the long side of the overall market, forget individual stocks, with the market, say, 20% above its normal valuation. When you have the fiscal recklessness problem, you have supply chain problems, you have the worst geopolitical situation I've seen in my lifetime. 78, 79 was bad, but I mean, for the first time, where it's a very low probability, but you got to put the potential outcome of world war on the table. Not exactly an environment that excites me about paying 20 to 30% above the multiple for equity prices. So, the next 6 months, who knows? And we're certainly washed out to some extent, but luckily I don't have any clients, so I don't have to worry about FOMO and, performing. And I just find the market as a whole, not that interesting, but I do find very interesting things all along in the short time. It's been an interesting year. We have not lost money in our shorts this year. Shows you how narrow the market's been, and we've done very well in our longs.
Interest rates, short rates are just over 5, long rates are around 5. What's your thoughts on 2 years and 30 years?
It's a great question. Normally, given the economic outlook I have, which is something's going to break, the anecdotal has turned, oil, interest rates and the dollar up, never been good for the economy, I would be long bonds. That would have been my process the last 35 years. because of the rant I went on the first 15 minutes. I'm not only not long bonds, I'm short bonds. But because I'm now worried about the actual economy, here's the sequence. I was short bonds from May until July by themselves. In July, I kept that bond short, and I added a 2-year long and more bond shorts. About 2 to 3 weeks ago, I started to get really nervous about something break, and I don't want to over-intellectualize bonds, but because of everything we talked about, I didn't want to cover them. So I bought a massive leverage position in 2 years. So I'm now long a lot of 2 years. I already had a steeper run, and I'm short 30 years. But I now have an overage in 2 years, so I'm actually long fixed income for the first time since 2020. But to be clear, I'm short bonds and I'm long the front end.
While Druckenmiller says he is not particularly excited about the overall market, as he still believes that it will be flat for a while, he expects to see opportunities as a result of the green economy stimulus and the rise of AI. Governments worldwide are committed to reduce carbon emission and shifting towards renewable energy sources like solar, wind, and hydroelectric power. The US government just announced a $20 billion stimulus in the field. This transition opens opportunities in various sectors. When it comes to renewable energy, there are 3 main sectors you should probably look into. First is infrastructure. Investing in the development and expansion of renewable energy infrastructure, such as solar farms, wind turbines, battery storage facilities. Then technology. Companies involved in developing innovative green technologies like energy-efficient solutions, electric vehicles, and sustainable materials are poised for growth. And lastly, policy and regulations. Investments in companies that comply with or benefit with government policies and incentives promoting sustainable and clean energy. He also talks about the opportunities created by AI. AI isn't a new concept, but this year's widespread adoption, notably with the mainstream launch of ChatGPT, spurred major tech firms to leverage AI for business purposes. This surge continues to generate unforeseen opportunities both in the short and long term. Companies at risk of AI-driven replacement could be potential short targets, while those enhancing efficiency through AI might experience substantial growth. The impact of AI developments hold the potential for significant fluctuation in various company trajectories. AI is expected to have a significant impact across various sectors, notably in technology, healthcare, and finance. In the tech sector, AI-focused companies engaged in machine learning, robotics, natural language processing, and automation are becoming pivotal investment opportunities. In healthcare, AI is driving transformative changes by introducing predictive analytics, personalized medicine, and advanced diagnostic tools, thereby opening avenues for investment in healthcare technology. Likewise, within the finance industry, AI-driven algorithms are revolutionizing financial services. They are reshaping processes such as algorithmic trading, risk assessment, and fraud detection, presenting compelling investment opportunities. In the first half of the year, the stock market showed positive momentum, but in the last 2-3 months, it has remained rather stagnant. Druckenmiller attributes this performance to the long period of QE, during which a substantial portion, about 30% of circulating dollars were created within just the last 4 years. Contrary to the common belief that stocks tend to rise in the long run, Druckenmiller suggests a different scenario. He anticipates the market to potentially remain flat in the foreseeable future, owing to the effects of QE, persistent supply chain issues, and the geopolitical landscape, which, although a small possibility, includes the risk of a global conflict. Druckenmiller also emphasizes the simultaneous rise of oil, interest rates, and the dollar. Historically, when these 3 elements surge within a year, it has a terrible effect on next year's earnings. But knowing all this, what he invests in now? He said he bought a massive bullish position in 2-year bonds. He spared long-short bond bets, being that he's expecting the yield curve to steepen, a move that typically happens when the Federal Reserve cuts interest rates. In terms of stocks, he also made a $100 million bet on Alphabet and bought $60 million worth of shares in Vistra Corp and Seagate Technologies. Thank you for watching.